All right, welcome class. Come on in and get settled. I am absolutely thrilled to be your guide today for your very first masterclass on the overview of accounting. Now, if you've ever felt a little, intimidated by giant ledgers, complex spreadsheets, or all that heavy financial jargon, just take a deep breath. You're in the right place. Today, we are going to patiently and systematically master what we call the language of business. You see, accounting, it's really not just about doing math. It is the foundational language that tells the very real story of literally every successful enterprise in the world. And by the time we wrap up today, you are going to start reading that story with absolute clarity. Okay, here is our syllabus for today's session. We're going to cover 6 main areas. First, the nature of accounting. Then, assets, liabilities, and equity. Third, methods and double entry. Fourth, fundamental principles. Fifth, the legal environment and ethics. And finally, number 6, technology and processes.
So let's jump right into Section 1, the nature of accounting.
Before we look at a single number today, I actually want to pose a question to the class. What do you think accounting actually is? I mean, is it just sitting in some dusty back room, crunching numbers and adding up paper receipts? Or is it something far more strategic than that? Well, to answer that, let's look at the official definition according to the upcoming Circular 99/2025. Accounting is officially defined as the process of collecting, processing, verifying, analyzing, and providing economic and financial information to support decision-making. Now, I want you to pay really close attention to those active verbs there. We are not just passively collecting data. No, we are vigorously verifying it to ensure it's completely accurate. We are critically analyzing it to spot hidden trends. And most importantly, all of this demanding, highly detailed work, it leads directly to decision-making. As accountants, you are the crucial architects of the information that leaders use to steer their entire companies.
Now, this language of business we're learning, it's actually broken down into 2 distinct dialects. On one side, we have financial accounting. This dialect serves external users. We're talking about investors, banks, and tax authorities. And because this information goes out to the public world, it absolutely must be highly standardized, it complies strictly with mandatory legal formats, and it essentially looks backwards at historical data to report on what has already happened. On the other side of the coin, we have managerial accounting. This one is exclusively for internal users, like your board of directors or your department heads. It's highly flexible, it's strictly confidential, and instead of looking back, it focuses intensely on future forecasts to help management navigate the road ahead.
But here's the thing, regardless of which dialect you are speaking, our financial information has to possess 6 specific qualitative characteristics. It must be a faithful representation, it has to be neutral, complete, timely, understandable, and comparable. Let's just focus on one of those for a second to see why it really matters in the real world: timeliness. Imagine you're the lead accountant, and you record a massive chunk of revenue, but you do it 2 whole months late. That is a direct, severe violation of timeliness. Why? Because your management team is going to look at their year-end profit, they're going to see way less money than they actually have, and they're going to make terrible, uninformed decisions about profit distribution and future investments. So remember, bad data timing literally leads to disastrous business decisions.
Moving right along to Section 2, assets, liabilities, and equity. First step in our basic building blocks, we have assets. Assets are, very simply, resources controlled by the enterprise that will generate future economic benefits. Now, in accounting, we divide these assets into 2 distinct buckets based on a very strict, uncompromising time threshold: 1 year. Please write that timeline down. Current assets are resources you expect to either convert to cash or completely use up within 1 year or less. Think about the actual cash sitting in the company bank account, the physical inventories on your warehouse shelves just waiting to be sold, or your short-term trading securities. On the flip side, non-current assets are all about the long game. These will benefit the company for more than 1 year. This includes tangible fixed assets, like the massive factories and heavy machinery you use to build your product, or intangible assets, like long-term software patents. And that brings us to the absolute golden rule of our profession. I want you to highlight this in your notes and memorize it completely. Total assets equals liabilities plus owner's equity. This right here is the basic accounting equation, and it is the bedrock of literally everything we do. It simply means that absolutely everything a company owns, its total assets, must be financed in one of 2 ways. There's no third option. It is either financed by borrowing money, which gives us our liabilities, or it is financed by the owner's own invested funds, which is our equity. Let's look at the simple math.
If a local store has total assets of 500 million Vietnamese dong and it owes the bank 200 million dong in liabilities, well, simple algebra tells us the owner's equity absolutely must be 300 million dong. This equation must always, always remain perfectly balanced, no exceptions.
All right, Section 3, Methods and Double Entry Bookkeeping. To do our jobs properly, we rely on 6 core accounting methods to ensure absolute airtight accuracy. First, we use accounting documents, like physical or digital invoices, to definitively prove that a transaction actually happened. Second, we use accounts to categorize similar items, like grouping all our cash transactions into one single place. Third is double entry bookkeeping, which we'll dive into in a second because it is the absolute engine of our system. Fourth is cost measurement, where we value things precisely at their historical cost. Fifth is the physical inventory count. And yes, this means literally walking into a dusty warehouse with a clipboard to make sure the physical boxes on the shelves perfectly match what's in our digital records. And finally, number 6, aggregation and balancing, where we pull all of these separate puzzle pieces together into unified financial statements.
Let's look much closer at that third method I mentioned, double entry bookkeeping. The unbending rule here is that every single transaction impacts at least 2 accounts. Let's walk through an example together, and we'll take this nice and slow so everyone follows. Suppose our manufacturing company purchases raw materials for 20 million dong, and we pay for it instantly in cash. Okay, what happens? Well, on one hand, our stockpile of raw materials is going up, so we debit account 152, which is our raw materials account, for 20 million. But on the other hand, our cash balance is decreasing because we just paid for those materials. So we credit account 111, which is our cash account for 20 million. One asset goes up by 20 million and another asset goes down by the exact same amount. Total debits precisely equal total credits, and our golden equation, it remains perfectly balanced.
Moving on to Section 4, Fundamental Accounting Principles.
Operating under Circular 99/2025, there are 6 main principles that we, as professionals, must obey. I want to highlight 2 really crucial ones for you today. First, the accrual basis. This means we record transactions exactly when they occur, not when the cash finally changes hands. So think about this. If you make a 100 million dong sale to a customer on credit today, you must recognize that revenue today, even if the client doesn't actually hand you the cash until next month. The economic event itself happened today. Next is historical cost. This dictates that we record assets at their original purchase price. So if you bought a piece of heavy machinery for 500 million dong and suddenly there's a booming market and everyone says it's now worth 700 million, you do not change your books. It stays recorded at 500 million. In accounting, we value hard, provable facts over wild market speculation. Next up is Section 5, Legal Environment and Ethics.
Listen, knowing the math is only half the job. As accountants, you hold incredible power over a company's narrative, and you absolutely must operate within a strict legal and moral framework. Legally speaking, please note that Circular 99/2025 will be effective on January 1, 2026, and it fully replaces the older 2000/2014 framework. This is a massive, massive structural shift for us because it converges our local practices heavily with international IFRS standards, bringing us right onto the global stage. But beyond the written law, there's our unyielding professional code of ethics. We're talking about integrity, objectivity, professional competence, confidentiality, and professional conduct. You're obligated to reflect the true nature of transactions. You must never bow to pressure to manipulate data, and you must never, ever disclose confidential financial figures.
Let's actually test this ethical framework right now with a real-world dilemma. Here's case 01 for the class. I want you to imagine you're sitting at your desk, just doing your job, and your company director walks in. They instruct you to immediately record 500 million dong in revenue that the company has not actually earned yet. Why? Well, because they want to window dress the financial statements to impress the bank and secure a massive loan. Take a few seconds to really think about this. What should you, as the licensed professional accountant, do in this exact situation? All right, if your answer was to firmly refuse the instruction, you are absolutely correct. The guidance here is crystal clear. We must apply the principle of integrity and our professional ethics. Furthermore, Article 15 of the Law on Accounting strictly and legally forbids inflating revenues or falsifying documents. As an accountant, your ultimate loyalty is to the objective truth and the law, not to a director's desire to secure a bank loan through deception. Okay, let's try another one. Let's go back to those definitions we learned earlier in the masterclass. Here's case 02. A company purchases a brand new warehouse management software system. It costs 80 million dong, and the vendor guarantees it has a 3-year useful life. Based on these specific facts, how do we correctly classify this?
Is this software a current asset or is it a non-current asset? Take a moment, think back to our strict time threshold rule.
All right, let's break down the logic together. We must apply the strict definition based on useful life. Because this software will be used by the company for 3 years, which, as we know, is strictly greater than our 1-year threshold, it simply cannot be a current asset. It must be classified as a non-current asset, specifically under the new Circular 99/2025. It falls under Account 213 as an intangible fixed asset. You see, when you know the foundational rules, the logic dictates the exact right answer every single time.
And that brings us to our final part today, Section 6, Technology and Processes.
We have discussed the theory, we've covered the laws, and we've mapped out the equations. Now let's look at how all of this flows in the actual real world. The general accounting process is a highly systematic 5-step journey. Step 1. A business transaction occurs, so a sale is made or an expense is paid. Step 2. We prepare the supporting documents, like issuing a formal invoice. Step 3. We carefully analyze and post these transactions to our specific accounts using those double entry rules we just learned. Step 4. All of this account data is systematically entered into our ledgers. And finally, Step 5. We aggregate all those ledgers to prepare the final, polished financial statements. It is a precise, beautifully logical assembly line of data. Of course, when you get out there in the workforce today, you are not going to be doing this 5-step process with a pen and paper. Modern accountants are true technologists. We use integrated ERP systems like SAP to manage entire global enterprises. We use cloud-based accounting for real-time collaboration. And increasingly, we rely on AI automation to instantly handle document classification and data entry. It's an exciting time. Now, as we wrap up our masterclass today, I want to leave you all with a challenge. For your homework, I want you to distinguish between the prudence principle and the materiality principle using real-world business examples of your own. I want you to think carefully. When does an accountant actively choose to be cautious versus when do they decide a financial detail is simply too small to matter to the big picture? Think on that, study your notes tonight, and I will see you all in the next class.